With a recent dividend cut and some serious cash flow problems, we need to find out if AQN is still worthy of some investing cash. Fasten your seatbelts, folks. This is going to be a good one. Algonquin Power Utilities started way back in 1997 as a power income fund, and by 2009, they had transitioned into a corporation due to some tax catalysts. They do operate as both a renewable energy company as well as a regulated utility company. A lot of their U.S. business is heavily regulated. Regulation normally provides a lot of stability. However, the heavy U.S. exposure also provided some pain as those interest rate hikes set in. Algonquin is a company very accustomed to using debt as part of their normal mode of operations. Unfortunately, those rising rates would cut into their cash flow, and a situation was created that was going to diminish their standings as a dividend aristocrat and a favorite amongst Canadian investors. Join the conversation. Let us know in the comments if you are a former or current holder of AQN. Your participation is well appreciated. Don't forget to like and subscribe to stay up to date on future content, and a huge thank you for that click. With so many people loving or hating this company, I don't think looking at their externals are going to really help us answer the overall question as to whether they are still worth investing in. We really do need to get into those fundamentals, and now more than ever, we need to turn to our good old buddy, Mr. Math. As we normally do, we will start off with some surface data. Their market cap comes in at $7.12 billion. Now, this is a market cap that was $12.66 billion just a year ago. Shedding $5.66 billion in just a year is, well, it is absolutely very concerning. Let's take a look at their beta. It does come in very stable at 0.22. This beta is, well, it is very stable, and that is the power of regulation. Their earnings per share come in at 0.37, and they have a price to earnings ratio of negative 129.30. The average in their sector is 11.7. We can already see they are not making a profit. And in a situation like this, I really prefer to look at their, well, at their price to sales ratio, which comes in at 1.90. The average in their sector is 1.5. Their price to book ratio, that comes in at 1.34, and the average in the sector is at 1.2. Looking at some of these numbers, it is very hard to compare them to any of the other companies in their sector. That is because, well, at the current moment, their boat's kind of sinking. Let's just switch on over to cash. Let's see what they have on their books. So their revenue comes in at $2.81 billion. Now, from that number, we actually would deduct $1.7 billion. That's their typical cost of sales. And then we have another $1.10 billion in expenses. And if you do the math, that leaves us with their earnings at negative $41.41 million. If there is any good news, they are actually projected to raise those earnings by 29.03% per year. So let's hope that happens. Their current free cash flow, that comes in at negative $443.98 million. We definitely have some cash problems here. Now they do get back into the positive for their operating cash flow. That comes in at $487.09 million. Let's take a look and see what their fair value is. So their current value right now comes in at $10.43. When we use a discounted cash flow model, we get a fair value of $12.44. So that does actually show them as undervalued by 16.2%. Although with some of these other numbers, I don't know how much of an impact that would actually have on my decision. Let's take a look at their returns. So currently they have a dividend yield of 5.565% that is paid out quarterly in the amount of 10.8 cents USD per share. This is a heavily slashed dividend, as it had a yield of 9.55% the last time we checked in on AQN. I did say then that it would make sense for them to cut it, and I guess, well, I'm not so shocked that they actually did. Their payout ratio, it comes in at negative 1,071%. Wow, currently this is simply a company that is unprofitable, and the dividend is, well, it's unsustainable. They don't have the cash to pay for it. Will they cut it further? That is a good question, and I think it is a possibility. When we look at their returns, on their 3-year, their price fell from $18.58 to $10.34. That is a return on investment of negative 44.35%. You add in those dividends, and it doesn't help much. We still get a total return of negative 34.08%. Whew, if you remember that big loss in market cap, I can see it. I can see it there. When we look at their 1 year, their 1 year's not much different. They fell from $18.53 to $10.34. Return on investment comes in at negative 44.20%. That gives us a total return after we add in the dividends of negative 41.08%. Holy banana bread. That's just not looking looking too good at all. Let's take a look at their 2023 returns. Now, in this case, their price actually did rise from $8.93 to $10.34. So they do have a return on investment in 2023 of 15.79%. Factor in the dividends, we do get a total return of 18.21%. Following that 3-year and that 1 year, I have a hard time getting excited about this one. As bad as things are, they could get worse because we're going to go in and take a look at their debt. Their total debt comes in at $7.90 billion, and they've got a total equity of $7.38 billion. That means their debt to equity ratio is only 107.1%. This debt to equity ratio is not as bad as it could have been, and it has actually been improving. 5 years ago, it was 120%, so they are moving in the right direction. When it comes to cash and equivalents, they have $61.04 million on hand. Let's take a quick look at their short term. Their assets come in at $1.05 billion, and their liabilities, they come in at $1.39 billion. So not ideal. Let's look at their long term. On the long term, a little bit of a better situation. Their assets come in at $16.88 billion. Their liabilities come in at $9.16 billion. Overall, their debt situation is not ideal, and it could be, well, it could actually be worse. Not to say that it's good, as this debt is not covered by their operating cash flow, and the interest is absolutely not covered by those negative earnings. So what is the final verdict on Algonquin? A lot of investors are sour on Algonquin because of that big dividend cut. This is completely understandable, and it makes it very easy to be wary of investing in this company. However, is it as bad as most people seem to think it is? That is not a simple answer. From my personal perspective, it is a very risky investment because we have already seen them falter big time, and I can't help but feel that the pain is not done with. Some analysts do believe that they can become profitable within 3 years, but honestly, I would prefer a company that is profitable, well, already, like now. Short term, this is not a play I would recommend. They have cut their dividend, shed a significant part of their market cap, and I do not see any upside worth the significant risk that comes with them. Long term, we have a little bit of a different story, but it's still in the same genre. They more than likely will recover, and there is going to be a need for diamond hands if you want to invest long term. I do think they will eventually recover, but once again, there are actually better utility companies out there that are not so risky. If you are already holding AQN at this point, I would probably not sell. They have made some strides lately, and even though there is still pain ahead, I don't think it will get much worse, and the long-term upside is perhaps better than selling now at a loss. Keep in mind, this is a company that did underperform when the oil sector was booming, so I'm not even sure if I'm 100% confident with their current management. I would just be very cautious with this one and throw on an extra heaping helping of due diligence before you even consider touching these guys. Keep the learning going. Watch my video on the new ETF Dream Team linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you in the next video.